so clean right now to take these bets. As I said, it's the easiest macro risk taking cycle of all time, because now we've got this two mega trends. Well, technology, which is basically, even we can take in the energy trade, it's energy, it's solar, it's energy, robotics, AI. And then we've got the crypto mega trends. And then I think defense is probably a mega trend, as you've said. And it makes it super easy. And once you throw in liquidity, things move. I mean, we've made so much money in Pro Macro and GMI out of just options. Because the velocity of the moves is so much higher than the option market price in.
Hey guys, welcome to Everyday Finance. Rather from being a random drop, the latest cryptocurrency flash crash is a manifestation of deeper liquidity cracks, according to Raoul Pal, who analyzes the situation. Volatility skyrocketed, leverage was wiped out, and traders who had overextended themselves were wiped out in a matter of minutes. It is explained by Pal that these rapid resets are a part of the larger macro context, which includes increasing yields, tightening liquidity, and markets recalibrating after months of speculative excess. In addition to a reduction in price, this is also a stress test. Something that is built on substance is what is still around today.
And do you think this is happening now because the banks have all roughly repaired their balance sheets? That was the thing that the central banks went, they're good enough to lend again?
Yeah, I think that's a big important lesson here, that central banks will not allow private credit creation in size unless the stress tests of banks look good. And it took a while for them to get the banks to where they are today. Especially the big banks look incredibly solid from a balance sheet perspective. And I even think households look very solid from a balance sheet perspective, despite high bond yields and all of that. One thing is, fair enough, you see this calculation all the time. Oh, it's very difficult to buy a home. But that, of course, rests on the assumption that you need to borrow, say, 95% of the purchase price. But, all of the households involved in the housing market over the past couple of decades, they don't need to borrow to buy, more or less, right? So they have an incredibly strong balance sheet, given this. I know it's a very different question if you're new to the market, you haven't bought a home and all of that. But those already involved in the real estate trade, they have tremendous balance sheets.
The swing factor to me is, okay, we've outlined that globally it seems there's a shift from the net liquidity measure, which was government and central bank, moved out to this total liquidity where they're using the balance sheets. We see it in Japan, Europe, US. Okay, so we've established that. The liquidity comes via that mechanism. But the next phase of that, to make that freeing up of the balance sheets, has to be lower interest rates. Because if not, we go back to our conversation we were having about the ISM. It's super low because rates are too high for the average company. It doesn't matter to fucking Google, Microsoft, Meta, Tesla. I mean, Tesla it does a bit, but most it doesn't matter to, because they're just cash flow positive machines. And so they just make more money when rates go up because they put their treasury into it. But surely they've still got to get rates lower.
It brings me back to the question you asked about the Japanese yield curve and whether it had global implications. The one way that you can ensure that foreign investors, institutions like life and pension funds, sovereign wealth funds, etc., can buy longer dated US treasuries is to ensure that the short end bond yields are very low. That's the most important thing for an administration to orchestrate. Because if you're a life and pension fund in Japan, it's written in your policy that you need to foreign exchange hedge your exposure between the US dollar and the Japanese yen. And this becomes slightly technical, but let me try and explain why it matters if short end bond yields are low. When you look at the equation seen from Japanese soil, if you want to buy, say, a 10-year treasury, you need to take into account that you need to hedge the dollar exposure back to Japanese yen when you buy this 10-year treasury. And the cost of doing so is roughly equivalent to the spread between 3-month bond yields in the US and 3-month bond yields in Japan. So if you orchestrate a situation where long-end bond yields are, let's say, at 4% and short-end bond yields are at 1%, you have the sweet spot for foreign buyers to go into the US Treasury market, because the spread you pay to hedge the FX cost is very low, but there's actually a premium in buying 10-year bond yields. So the steeper the curve, the better. And you and I know very well, if you cut rates a lot, you'll get a steep curve, and that's essentially what they need. So I think you're spot on that. Currently they even have like they have the labor market as an excuse to keep cutting in the US, right? So I don't think they need a lot of political pressure to just continue cutting. But who knows whether he'll appoint a complete joker as the next Fed chair, willing to bring interest rates to 1% or whatever.
In the end, you kind of understand if you were the Treasury Secretary and you've got $9 trillion of debt to roll, you all know the game this is the game that has to be done, then you can't have an independent central bank.
No, the question is whether we've ever had an independent central bank.
Obviously.
Yeah.
I mean, Yellen's move from the Fed to the Treasury made it fucking clear that it was never independent.
But I think to add a bit of spice to that mix, what happened roughly 2 years ago as well was that the credit creation moved from the central bank balance sheet to the broader economy.
Yeah.
And a lot of people completely missed that. Because if you look at the Fed balance sheet, it's basically flatlining, right? We know the reason why. We have quantitative tightening running in the background. Then you have a couple of countering factors, but the balance sheet is flat. And basically,
the Fed net liquidity measure is flat.
Yeah. Yes, exactly. And therefore, the money created since 2023, all of that credit creation has happened in the private sector and in the treasury deficit, basically. So, of course, if you run a huge deficit and private banks create money by lending out to households, corporates, you're going to see an explosion in liquidity just from another source. So essentially 3 agents in an economy can create a dollar. The Federal Reserve can create a dollar. That's what we've been used to being the key driver. The US Treasury can create a dollar by running a deficit. And a commercial bank can create a dollar by lending out and increasing their leverage. And it's only 2 out of 3 agents that have added liquidity for the past couple of years. And the Fed is not one of those 2. And that, I think that has caught a lot of people offside.
We looked at this and wrote a lot about it in GMI and Real Vision Pro. It seems that they're trying to move the game when people understand what the game is. So at first it was the balance sheet from 2008 until 2012, 13, 14. Then it became Fed net liquidity, which is all of those measures. And now they've gone to total liquidity, which is really right now being entirely driven by the private sector. But it's still liquidity. And I love the way you put it. There's 3 ways you can create a dollar. You need to keep your eye on all 3 ways. And there's also a certain amount of liquidity that comes from issuing short-end bills as opposed to long-end. It seems like that's a liquidity provider.
In the meantime, Peter Schiff has returned with his signature skepticism, predicting that Bitcoin would eventually cease to exist and return to zero. Schiff accused Bitcoin's early adopters of executing the greatest pump and dump in history, stating that they sold a dream to offload bags. This accusation was made during a heated argument with Michael Jerome, an influential figure. In order to demonstrate that the narrative surrounding digital assets is beginning to unravel, he cites the underperformance of Bitcoin in comparison to gold, which has lately reached all-time highs. A financial catastrophe in the United States that is worse than the one that occurred in 2008 is on the horizon. According to Schiff, and it is rooted in the collapse of faith in treasuries and the dollar itself, in his opinion, the entire economy is a debt bomb that is about to explode, and Bitcoin will not be the safe haven that people anticipate it to be.
When you look at how geopolitically important this is the most important technology the world has ever made. And he who wins this, wins the world. It's that big a technology. And China is scaling electricity via solar at an unprecedented rate. There is no choice but the US to do the same. There is no choice.
No, it's essentially an arms race by the end of the day, right?
That's right. And, David, Matt, and myself look at this. It's a flywheel. And the whole game is basically intelligence per unit of energy. That is the whole game we're in now. Everybody is on that game. And that's driven by energy, compute, intelligence, energy, compute, intelligence. And that thing keeps spinning. And energy is the base layer. And people, it's hilarious because you see long-term oil and gas people saying, well, it's definitely going to drive up the price of oil. It's just not, because it's not fast enough to scale oil. We can't use the grid. The grid is not able to cope with this. So we have to have decentralized grids. And the only way of doing that, until small nuclear turns up in 10 years' time, is it has to be solar and gas.
I love the storytelling around small nuclear reactors. I've made a lot of money on nano nuclear this year, but realistically, there are still a handful of years from really scaling this, right? And we don't have that time, given what's ongoing in China, not least. You're absolutely spot on when you say that China has doubled its capacity just via solar in a year, and that chart looks absolutely magnificent. It's probably the macro chart of the year, in my opinion.
Yeah.
And I don't think a lot of people have noticed yet, especially if you look at the domestic case for solar in the US. It's completely bombed out still. Some of the best names that I can think of, they're still down 70-80% since 2021. So we're very early in this story.
Because the solar story before was basically about households.
Yes.
The kind of redoing what Germany and Europe did was get households to use a lot of solar by giving them subsidies to bootstrap it. But they're missing the fact that the solar demand is actually going to come from data centers, and it's not from households. Sure, households will adopt it over time because the cost of solar keeps falling. It's ridiculous. It's one of the best trends of all time is the collapsing cost of output per solar panel.
But to mention one name, right? We're talking about solar in a broader sense here. The company Nextracker from the US is a really, really interesting case because they have more than 500 patents around how to optimize the yield from solar panels when the sun moves during the day. So they're one of the very few companies not having to deal with this extreme price dumping on solar panels happening out of China. And I think that's, a core play in the domestic US market when the adoption of solar picks up speed in the US, because they, you simply cannot avoid them if you want an optimized yield on your solar panels. I think for me, that's the key play here.
It's really interesting because here's two macro people talking about equities. And not in terms of broad sense, but we're in sectors and single stocks. It's interesting. A friend of mine works for one of the most famous hedge fund managers of all time, who's now family office. And he said, oh, no, we turned into an equity shop years ago. Yeah. Because of the opportunity set that's happening because of technology and other stuff.
Yes.
So, the amount of bond bets or currency bets that happen is very small now. It's kind of like it's been equities and crypto, which is what we've all got to.
But, you've seen it again this year. If you get the thematic play right, and you square that with the liquidity cycle, you can find some 5-10x cases in solar, in nuclear, in AI, in high performance computing, in quantum, etc. Right? So if you combine the thematic research with the liquidity and business cycle framework, why would you trade dollar yen or whatever to try and squeeze 10% out of that? It doesn't really make any sense. Not even from a Sharpe ratio perspective, right? Because the Sharpe ratios on these cases is absolutely magnificent. Even the Sortino ratio, where you only look at the the upside volatility, is amazing, right? So I think you're absolutely spot on, and I think I know which fund you're talking about. So, yeah.
It's just so clean right now to take these bets. As I said, it's the easiest macro risk taking cycle of all time, because now we've got this two mega trends. Well, technology, which is basically even we can take in the energy trade. It's energy, it's solar, it's robotic, energy, robotics, AI. And then we've got the crypto megatrend. And then I think defense is probably a megatrend, as you've said. And it makes it super easy. And once you throw in liquidity, things move. I mean, we've made so much money in Pro Macro and GMI out of just options. Because the velocity of the moves is so much higher than the option market price in.
An old debate was then revived by Jack Dorsey with a straightforward comment on X, which was as follows: Bitcoin is not crypto. The argument he is making is profound. Bitcoin is unique in both its design and its functioning, because there is no pre-man, foundation, or central team. The only thing that this decentralized network is concerned with is money. It is not about apps or speculation. Bitcoin functions similarly to digital gold in that it is scarce, stable, and resistant to manipulation. Its quantity is fixed at 21 million, and its upgrade path is determined in a planned and conservative manner. When Ethereum and other cryptocurrencies are competing to develop, Bitcoin's strength lies in its ability to endure. As a separate asset, it is regulated as a commodity, and it is held in exchange-traded funds. Institutions respond differently to it. One thing is certain, regardless of whether you agree with Dorsey or not, Bitcoin has progressed beyond the confines of the crypto moniker. This is not merely a component of the market. Rather, it is its very own market.